All right. Good evening, everybody. Good to be back. It's been a while since we've done one of these. Lot going on. Hope to catch up with some great information for you this evening. Whether you're in the business, realtor, lender, or you are current homeowner or hopeful homeowner here in Silicon Valley, want to give you some what I think is some really interesting information on what you need to know. We are now full 7 months into 2020, at least in terms of all collected data. Peaks and valleys within 1 year like we've never seen before. And usually in real estate data, we're always measuring year over year or month over month, one period to the next period, just because we use typical cycles. And where some years are higher, some years are lower, there is usually a sort of understood trends, understood rhythm to a real estate year, and that has not been the case this year. And that's kind of messed with us a little bit in terms of knowing and understanding what we can and can't do, answering questions about what's next, answering questions about pricing and availability, things like that. But I think we've got a good, clear mind, and now about almost 3 months of data since the stay-in-place orders were issued, where we can start to see and analyze the mini cycles within this year. And it's actually pointing to a really robust market for, I would say, the next 6 to 9 months, certainly through spring of next year. And yes, I understand we still have a lot of news to go through politically, economically, socially. But imagine the news we've been through in those 3 areas in the last 3 months, and real estate has gone full steam ahead. So keep that in mind as we talk through and go through all what we share this evening. As usual, Carol's here with me. If you have any questions, if something doesn't sound right or just something spurs a question as we're speaking, go ahead and text the question into the Q&A. She'll read it to me if we have time to answer it. If not, we'll follow up. And with that, we'll jump right in. All right, so here we go. All right, so what's going on? Where are we at? Where are we headed? What are the experts saying? They're saying a lot of things, right? And something I touched on if you were listening to Terrell Now earlier today, this idea that people are fleeing the cities and moving out to rural areas. And what I shared this afternoon was those headlines. It's not that they're wrong. They have some truth to them. They have a lot of truth to them. The pandemic and stay-in-place orders and shutting down of so many services, restaurants, and the things we're used to in a big city, the ability to work from home, the ability to go to school from home, or the necessity of both, is kind of changing what people think about home. It's kind of changing the kind of house they want, the neighborhoods they're looking for, even the cities that they're looking for. And so what I want to focus on is don't chase the headline. We'll show you here in the short order. The headline can be true, and yet it can be overstated at the same time. So we'll start with this from Inman News today. Despite forecasts of people fleeing cities en masse, home prices grew in 96% of metros in the second quarter, according to the NAR. Now, prices only grow when the demand is there. And so in the largest metros in the country, the prices grew during the pandemic and the immediate aftermath. And this is what we're seeing. Prices rose by 96%. The national median existing single-family home clocked in at $291,000. All right, they rose here in the Bay Area too, so don't get seduced or go astray with that low median price. These trends hold even in our areas, and we'll share that with that in a little while. And then Lawrence Yun, NAR's chief economist, writes, home prices have held up well, largely due to the combination of very strong demand for housing and a limited supply of homes to sell. Historically low inventory continues to reinforce and even increase prices in some areas. That includes urban cores. That includes these largest metro areas. And he finishes with what the point I think is really important and should run through this entire presentation tonight. Unless an increasing number of new homes are constructed, some buyers could miss out on the opportunity to purchase a home or have the opportunity delayed. In the meantime, prices show no sign of decreasing. Now that's important because, of course, living and working here in the Bay Area, Silicon Valley, there's not a lot of opportunity to build new homes. And I think he said that on purpose because current homeowners are holding on to their homes, their existing homes at longer rates for longer terms than ever before. And if it's true that people want single family residences with a yard, that means those that have them are keeping them. So we will continue to see really low inventory, as we'll touch on in a second. We're continue to see historically low interest rates and what that means for our industry and what that means if you're thinking of selling a house or buying a house. All right, so that idea that when I say a headline can be true and yet misleading, this is what I'm talking about. So but what people are buying is changing. I put in here the absorption rate for pending sales for Santa Clara County. I pulled out single family residences and condo townhomes for the last year plus. I'm sorry, for the last year since January. And what you see here is kind of what those headlines are saying. In the beginning of the year, the entire market was on fire. It was really, really going gangbusters. And it was actually hotter condo townhomes than an SFR in Santa Clara County. Right around when the pandemic really hit, stay-in-place orders were initiated, the market collapsed. We all remember that. It seems like years ago. It was only months ago. And you can see that condo townhomes went from leading SFR absorption rate in pending sales to trailing it by the time we hit the bottom. And since then, both have rebounded very nicely. But of course, you see through July, SFRs continue to go up and condo townhomes seem to have hit a plateau. We'll see where it goes in August. We'll touch on that in a second. But this is what that headline is saying, right? People want SFRs. I'm going to show you in a second outlying areas. But mind you, 50% plus absorption rate on condo townhomes is an incredible seller's market. What you have to be careful of is comparing it to an even hotter market in a different class, right? And so this is what the headline is saying. They are true, but don't overreact to the headline and think this is a dead market in condo townhomes going nowhere. It's not true at all. It's one of the healthiest condo townhome markets we've had in a while. So keep that in mind as whether you're thinking of buying or selling. A lot of people thinking of selling a condo and moving into SFR. This tells you that that is in fact on a lot of people's mind. Whether they're actually doing it or not is yet to be seen, but they are thinking about it. You see consumer actions in a delayed format when you see backward-looking data like this. This means people were thinking about it in May, June, acted on it, and now that activity was recorded in July. They're still thinking about that. So think about it. Single-family homes going up quickly, prices going up even faster than your current condo townhome. That should be a real indicator. Act sooner rather than later, especially if you're in that trade-up market. The delta between prices in the two, there's always a delta, of course, but it's getting extended. Maximize, you may have already maximized or close to your condo townhome price, and that price of the house you want to move into is getting further and further away, all right? And that's why I think really important, we look at the headlines, really look at the data, and what do they really mean? Looking a little bit deeper, again, this is nationwide. We're gonna go deep into Silicon Valley numbers in a little while. But from what we see nationwide, again, from American Enterprise Institute's Housing Center, their median price, home price appreciation trend, you see this dip and rise is right around late February, mid-March, completely dropped. As you recall, when we started doing these, we immediately got all of these prognosticators saying home prices are going to drop. for the next 15, 24 months. And it's not that they were wrong. It's not that they were lying. It's when the data you're getting in real time is straight south, that's the data you have to use to look forward. So I don't begrudge them reading headlines saying prices are going to drop, they're going to collapse as we move forward. We did not know in real time when this bottom would happen. We did not know it would be in week 17. We obviously were hoping it did. Now in hindsight, imagine if you're right here saying prices got a long way to go down, and 3 short months later, the upside seems like it's endless. And we're back to this house prices only go up. All right. This is what I was referring to earlier. Think about all the terrible economic news. Think about the unemployment numbers. Think about the stock market's ups and downs. Think about the social unrest. And despite all of that news, right? You've all seen the jokes, everything about how what's the next crisis to hit in the coming month. It certainly felt like that, and it felt like that because it's kind of true this year. So think about all that horrible news that drove housing to this level, and in 3.5 months, not only did it stop the downward trend, not only did it rebound, it shot up like a rocket. Okay, that's what we're seeing. So we've got little over a quarter and a half to end this year. I know we have an election. I know we have resurgent hotspots with COVID. There's a lot going on, but can you really imagine 3 more months of bad news worse than we experienced in first and second quarter? And yet still this is how it rebounds, because inventory was so low, interest rates were lower and lower and lower, seemingly every week, every month, every quarter, and the demand remained high. And the people who were buying houses have not and probably will not be affected by unemployment. They likely will not be affected by any lingering recession fears or realities even, because it seems to be a distinct market. And you have this market of buyers of real estate relying on a very resilient economic market, jobs market, all of those things, stock market. And then you have a pool of sellers. And that pool of sellers is actually where the issues are, is they can't as easily sell and buy something else. And so that just points to more and more, or less and less, I should say, listings on the market. So put a lot of stock, no pun intended, in this chart and where it's headed. And just think for a second, if we got the news for the next 3 months that we had for the past 4 months, what would happen? The market right now is telling you nothing. It'll continue to move. All right, so pay attention to that going forward. Further, home equity levels improve across nation in second quarter despite coronavirus pandemic. Now, again, I'll remind you, thinking values are going to go down. Values go down. If you're a current homeowner, that means the equity in your home is getting lower and lower and lower. You're losing value, you're losing equity. That's what we were all thinking. That's what the numbers were saying. Now in August, we're saying, guess what? Second quarter, highest levels of equity ever. And halfway through the third quarter, that number is going to grow. It's going to continue to go up. So second quarter home equity picture reflects a housing market that put out strong but mixed signals amid a nationwide economic slowdown and all that went with it. Unemployment spiked, sales slumped in April, but it all recovered. It all shot back up. And now we have a market nationwide where equity-rich, the percentage of equity-rich homeowners is a record number. I show below here what when they use the term equity-rich, that means their loan-to-value ratio is 50% lower. Or the other way to look at it, they have 50% more of equity or more in their property. Biggest number in the nation in history. The West leading that number. In California, 43% of homes were equity rich. Of the 107 largest metropolitan statistical areas, number 1 in the nation was San Jose. Fully 64% of homeowners in this city and I realize some of you are listening from other cities, in San Jose, 64% have 50% or more equity in their home. It's amazing. Think about what we just went through, and that's a record best number ever, right? And that's going to continue to go up when we look at these numbers. Here we see um, nationally, the week ending June 27th, the original price, I'm sorry, forgot the slide that we were on. Further to the point on how strong the market is and how strong we expect it to get in the coming months. In such a tight housing market with so little inventory and so few choices for the record number of buyers out there, sellers are not having to cut prices. The sellers are getting what they asked for. If you're a buyer's agent, you know this. You don't need a graph. You don't need a slide for this. You know how hard it is to go out there and win right now. You know how hard it is to explain to a buyer, yes, I know it's COVID. Yes, I know people are protesting. Yes, I know the election is in question. Put your money down if you want this house, because that's the only way to get it. It's a hard thing to tell a buyer. It's a hard thing to try to explain when the most noise, the most inputs you're hearing seem to be negative. But when we're focused clearly on just housing, on just buying, on just moving into this asset class, these are the facts, right? So for only 4.1% of listings nationwide had a price drop, right? That's one of the strongest ever. So that was the best nationwide, comparing it to the strong market of early summer 2018, all right? I'm gonna keep going back and referencing late 2017, early 2018. If you're a realtor, you remember what that period was. I'm talking probably the 9-month period, June 2017 through probably early May 2018. It seemed stagnant. It seemed like it was dropping in that late 2017 period, and then it exploded. And any listing, any price, any condition was going for record prices. It was going for hundreds, $200,000, $300,000 over asking price. We had 20, 30, 40, 50 offers per listing. I'm going to show you statistically, numerically, how those conditions are being replicated, right? There's never any guarantee. No one has a crystal ball, but I can show you all of the conditions that existed in late 2017 and what that meant for early 2018, and they're all back in force. And this is one of them. Sellers are getting what they want, and it's slowly, it will gradually build and get even stronger. All right. They finished this by saying buyers may not like or agree with the asking price on homes they like, but realistically, they may not have many of the options but to accept it. Now, here's an important point, especially if you're a consumer listening to me right now. If you're working with a great realtor, and you should be, they're going to tell you, do you like this house? Do you want this house? I know they're asking 1.5, let's go 1.6. And let's minimize all the conditions so that they accept ours against everyone else's. And that's going to be hard to take on its face. But those are the conversations realtors were having with buyers in late 2017, early 2018. Those realtors were giving the advice, let's go $20,000 over, let's go $100,000 over, let's go $200,000 over. It must have seemed crazy in the moment. Now think about if you were that buyer late 2017, early 2018, and you bit the bullet, you trusted the advice, and hopefully the advice was being given because that realtor was paying attention to these indicators, and you wrote and you won that offer. What is your house worth today? Despite everything that has happened since spring 2018, when it seemed like, I can't believe I'm going to pay that much more than the seller is even asking for. And the numbers said it's a good move. All the data said it's a good move. It's your only move. If you don't do that now, you'll pay more later. And almost full 2 years, that is not only true, those buyers have gained that overpayment plus, and they're still going to win more equity in the coming months and weeks. So if you're that seller out there thinking it's a good time to sell during the pandemic, now we're going into the fall and winter season, which are slow selling seasons of a pandemic year, of an election year. Yes, it's a great time to sell. The conditions are ripe. If you're a buyer, buy now. As long as you can find something you like and want and need, buy now. You're going to pay a premium in a month, in 3 months, in 6 months, in 9 months. The advice we as professionals were giving late 2017, early 2018 were true because we could read the tea leaves, so to speak. We could see these numbers and we could see the strength in the market. And we owed it to our buyers to give that hard news. Go fast, go strong, go high. And it paid off in spades for those that bought. I guarantee you there are buyers in the market right now that have been waiting for prices to drop since late 2017. And they're only going to pay more in late 2020, early 2021. All right. Homes are being snatched off the market at their fastest pace in 2 years. We keep going back to 2 years. We keep going back to 2018. That is not by accident. That was a high water mark in real estate, nationally, regionally, locally. So whenever you see things like this, they're saying, wow, this is the best since, this is the fastest since, this is the highest since, that should tell you a lot. That should tell you a lot about what we're looking towards, looking forward in this market in the next 6 to 9 months. And that's why I included these articles from Zillow and Inman, and they're all in some way referencing best since, hottest since, highest since late 2017 or early 2018. This is the market we're looking at. All right. Now, before I scare you and say, if you're thinking of buying, say, well, then I'm done. I couldn't afford it in 2018. I couldn't afford it now. Here is the saving grace. And one of the biggest reasons why I'm confident as prices go higher and higher, saying it's going to get even better, right? Because the reaction that the markets have had was, well, if the house is more expensive, drop the interest rates. The interest rates have been falling so that we can still, as a home buying class, afford the monthly payment. If you're in the industry, you know buyers make decisions on the monthly payment, not on the price of the house, not even on the interest rate. Those things, of course, combine to create the monthly payment. But if the monthly payment is affordable to them based on their income, based on their credit, they will buy it, right? And here's where we are. Falling 30-year interest rates result in the highest level of home affordability in 3.5 years. There's that period again, late 17, early 18. Most affordable in 3.5 years. How is that possible? How can we sit here and say prices have gone up in that time, and yet it's the most affordable since that period? Because the rates have fallen so much, right? If you go to Black Knight's data analytics page, they have a great article. I cut a little bit out of it from here. And it says with rates below 3%, not to plug a competitor, but United Wholesale Mortgage announced a sub 2% this morning. It's just amazing. Falling rates and improved affordability helped spur home buying demand and therefore purchase origination volume, which provided a much needed backstop for home prices in the wake of the COVID pandemic. So all of this is going on at the same time. You have to really understand whether you're a professional or a buyer or seller. A lot of this is noise. A lot of this is not ultimately related to your purchase of a property, your sale of a property. You've got to dig down, look at where all the data leads and the takeaways are. Great time to sell now. All the conditions for values to go up are there. Great time to buy early in this period because interest rates are low. Affordability is back to 2017, 2018 levels in Silicon Valley market, believe it or not. There's never a guarantee for that. So if you've got a need or want to buy, now in the next 2-3 months is the time to do it. Either interest rates will go up and then you'll lose some of that affordability, or as we saw in 2018, sellers will put into the market, those buyers will gobble them up, raise prices, and that quick, fast, abrupt rise in prices will eat away the affordability that these sub 3% interest rates are creating. All right. And so that's why I can say with a straight face, fantastic time to sell, even better time to buy early in this period. All right. Here's some more from Freddie Mac. Great stuff, right? And whether you're a consumer or a professional, this is the kind of information you really have to have, because what I can be hard to understand way to look at. So you've got here payment to income ratios, and you see payment income ratios on the left axis, kind of flat for the last several years, not going up or down, and the interest rates dropping way lower, and especially in that, here we go again, 2018 period to today. All right, if these rates were here at that 2018 period, it would be a little harder. So think about that. When the market exploded locally in early 2018, we had just left a period of almost a year of rising interest rates. And now look, when you're always down at that sub 4.5% rate, it doesn't seem like from 3.5 to 4 is a lot, but the buying power that erodes when prices are already high is incredible. And so this is that stagnation we saw late 2017 that was kind of hidden because inventory was so incredibly low. We hit January 2018, no inventory. There was like 300 homes in Santa Clara County for sale, and then interest rates just dropped like a rock. And it was like jet fuel. And that's what's happening now. We're entering super low inventory market, incredibly low interest rates. And if we overlay prices in Silicon Valley through this period, they go straight up, right? And so those are the things you've got to pay attention to right now. Again, are you a home seller? It's going to be a great market for you. Are you buying a house? Buy early, not late. If you're a professional, these are the things you have to communicate to that buyer or seller, so you're not just speaking in terms of it's a hot market, never a better time to buy. Show them the facts, show them the numbers, show the data that allows you to speak cogently and honestly and smartly about the advice you're giving.
Question: how is Alameda County doing versus San Mateo, Santa Clara?
Someone asked, how is Alameda, Santa Clara County doing vis-a-vis each other? I'm going to touch on that in a second, so hang on. All right. Nationwide, these falling interest rates, here is the last time housing was this affordable by state. All right, so here we go. If you're a buyer out there, we're not crazy as realtors. We're telling you in terms of affordability, not in terms of price, in terms of affordability, we're back to January 2017 levels. All right, it's slightly higher in the Bay Area. We're about early to mid 2018 levels, but with our prices, that's still a good thing. That's a little bit, go back in time, let's reset the button a little bit, and let's start back where we did early to mid 2018. That's with all the rises we've seen since. So this is really important, and this is really good to see. And this is where we start to see, I'm going to share with you a lot of Santa Clara data. These meta trends are true everywhere, right? For example, if you're in Oklahoma, great news, you're back to 2012 affordability. I'm not making a joke there. What I'm saying is different markets in different areas, right? If we drew a map of the counties we don't have, but if we did, Santa Clara, San Mateo would be around 2018, 2017 levels. Outlying areas in our Bay Area would be just a little more affordable because the interest rates are the same there, but their average sales prices are lower than ours. So think of it that way. It's not like, well, you live in San Francisco, so you get 2.9% interest rate, and you live in Hollister, so you get a 4% interest rate. You both get the 2.9 if you qualify. But when you're applying 2.9 to an average sales price of 1.8 million, and you're putting in 2.9 on an average sales price of 650,000, that is a big, big change. So think about that when I talk about these points. If you're in Alameda, if you're in San Francisco, if you're in Santa Clara, if you're in Santa Cruz, you know what your average sales prices are, and you know what interest rates are. And know the lower your price point, the further back you would go on this map on where you are in affordability. But everywhere is at the lowest highest affordability in years, at the very least. Okay, I hope that answered that question. And I'll touch a little bit more on our outline areas in a second, so that we can get through a lot of this information. And then I'll give you an offer at the end if you want or need that specific area information. All right. So another little thing to share. One of the last times we were on together, we were right here, and I have been showing you great leading indicator for the market on what you're going to see next is, are people out there actually looking at houses? So if you've been watching this program since mid-March, you know now in hindsight, even if you didn't believe me at the time, this is a great indicator. We were here and I was telling you, we're past the worst, it's getting better, people are out looking, eventually they will buy, eventually that will drive activity and prices and everything up. We hit a little dip, looks like around the July 4th weekend, and then boom, took off again. So look how much further we are than 2019 at the same time. Look where we've come from, again, mid-March, early April, real estate is dead. Get ready for the foreclosures, right? And again, I'm not blaming anyone that had that idea, because when you are looking at current data, which is the best data to use to prognosticate, well, what can you say when it's only going down and down fast and down hard, right? And that's why you've got to be understanding, you've got to be aware, you got to be on top of it the entire time. And so, again, listen to the news, the abrupt, the never before heard, never before seen. What does it mean I'm not essential? What does it mean now that I am essential? And now, what bad news can knock you down that far again? I'm not saying there isn't, but it'd be hard to match it. So if you've been feeling this kind of hopeful resurgence in real estate, whether as a practitioner or an investor or an owner of real estate, it is with good cause. And this shows this. All the data shows that. Likewise, it's good to think that all of this is going to point upward minimum for the next 6 to 9 months. Okay. I think someone had a question. So again, how's the economy? It doesn't matter. And it's not probably smart of me to say that. It's almost like inviting bad news. But think about it. Good news, bad news, worst quarter ever, best quarter ever. Housing just chugs along. And it's just been going up and up and up in the last 4 months, despite everything else that's been going on. So take that with a grain of salt if you like. But again, I'm just paying attention to, if that was the best shot that the economy, that the pandemic, that a crazy election year can give to the housing market, what can happen, right? I guess the answer is anything can happen, but we can only use the data we have, the knowledge we have in this time and in this place to think about what's going to happen next. And it's all pointing to good news, right? Low rates continue the order of the day. I've been sharing this with you consistently, and we continue to see it. We continue to see that 2020 purchase rate locks versus 2019, and it's not an accident that it's going up and staying high, because the interest rate keeps dropping lower and lower and lower, and that's going to continue. And even if it tapers off and it doesn't drop anymore, staying anywhere in that 3 to 3.5% range should keep us at or above last year's purchase rate activity. And that should feed into 2021 for sure, through first quarter and into the spring selling season. This is why I'm so high on the market in this next period. All right. So Silicon Valley update. What's about here? All right. What's going on in our backyard? All right. Here we go. So I pulled the data as always for these counties, and we continue to see the same trends that since March 15th has been the order of the day. Inventory continuing to rise, not rising fast enough to make up for what we lost, but that was in some sense the good news. We didn't get that immediate dump of all the listings that we missed from March 15th to about May 1st, which could have damaged the market. Whatever the reason for not selling, those people are continuing to say, I'm still not selling. And so inventory has continued to track lower and lower and lower in the county, with some variation, but looking back past years, still the lowest we've seen in a long time. and continuing down that route. When we look at the move up year over year, and since the beginning of the year, again, very strong. Actives up, pendings even stronger. Condos and houses lagging a little bit. Actives up, way up, pending strong, but not keeping pace. Of course, we've talked about that for several weeks. If that continues, that's going to create a drag on pricing, on movement in the condo townhouse market. And that's exactly what we've seen. I share this yesterday because I was receiving so many questions about condos, townhomes, and why they weren't selling, and if they should drop prices and things like that. I changed something and said, well, look, this year is different. So instead of just comparing where we are today from where we started at the beginning of the year, why don't we compare where we are today compared to the beginning of stay-in-place orders? Very telling. When I did that, you can see from that first Monday after the stay-in-place order was given, inventory in both classes has risen, but dramatically so in condo townhomes. Pendings have gone up in the same SFR category. So we've seen that nice recovery there, buyers jumping back to the market. But we actually have fewer pendings in the county in condo townhomes this week than we did in the first week of the year. And that's what, if you've got a listing out there in a condo townhome, that's what you're feeling. If you're a seller out there thinking of selling your condo townhome and buying a single family residence, this is where my advice, do it now, don't wait, is coming from. You see, overall, this is still a strong market, but it's not as hot and it's not moving up as fast as SFR. So if you're thinking of trading a condo townhome for a single, the longer you wait, the greater the delta between what you will get for your existing condo townhome and what you're going to have to pay for your single family residence. This is a lot of different categories, a lot of different subclasses, and then to complicate it even more, when we throw in what's been going on in the pandemic, makes it a little harder to compare apples to apples. This is what happens in August. This is normal for June. This is what we can expect in September. And so this is why I'm sharing this with you. Right now, I have the data for San Mateo and San Benito on these charts. I'm not sharing them tonight, but if you email me, I'll send them to you because it shows the same kind of disparity. And I just don't have too much time tonight to go into all, right? Actually, I did.
Yes, you mean 2019.
Yes, I'm sorry. That was a typo on my part. That's 8/12/2020. Thank you for whoever eagle-eye that caught that. That was a mistake on my part. What you see in San Mateo County, same kind of move, except that inventory is way up and not as much as it is here. And then you see again the disparity in condo townhomes. So be very cognizant about the difference going on in the different asset classes right now relative to what has changed in buyer and seller attitudes since COVID and since stay-in-place orders and where their interests are going. All right. And in San Benito, really are no condo townhomes. That's just a crazy market right now. No inventory, can't find a thing to sell. But when they put it out there, it just gets gobbled up. It's just insatiable appetite for that class right now. And so this is what I'm talking about, okay? So this is why for the last 10 years, I've always shared this, because when I was managing an office and training agents to go and talk to buyers and sellers, I always wanted them to know what's going to happen next. And understand following the patterns really helped us do that. And this is what I'm seeing for the last 6 weeks or so, that what we saw in 2017, it's kind of like when you go to the beach and say, hey, look, if you're going to think of going in the water and you see the waves going out, don't go in. That's a riptide, right? There are things you can look for. There are things you can watch for. There are telltale signs. This is like that riptide, right? This is what's going on here. Everywhere else, the tide's coming in this one spot, it's going out. What does that mean? So you have here late 2017, and I've been tracking this since June. This has been true since June. And at the time I said, let's watch to see if it continues throughout the fall and winter. If it does, it's a big if, but it's not going to be a surprise. We track it each week, we monitor each week, and if this continues throughout the rest of the year, you're going to have an explosive 2021. What do I mean? When in the late summer, fall, winter months, inventory drops at such a big year-over-year number, while pendings are flat to rising, that's the environment we're in now. Actives dropping by 30% year over year, pendings rising. What did that lead to? It led to a record low number. So we woke up on January 2018 and we had 266 active houses for sale in the county and 585 pending. And you now know in hindsight what happened. The seller, the next 6 to 9 months, great time to sell your house. You're going to be really, really happy. I know it's different rules. I know it's different things that you can and can't do. But if you're just talking about maximizing the return on your asset, you're coming into a period that's going to be great for that. Interest rates are going to stay low. Buyer appetite is going to remain high. And as inventory continues to drop and goes anywhere close to this level, you're going to have that magic spring that we had in 2018. So watch for this. Again, you don't have to guess. If inventory explodes between now and December, if pendings drop between now and December, again, I'm not guessing here. I'm just saying this is the trend we're seeing now. If these conditions remain, we know exactly what will happen in January, February, March, and April of next year. And so far, 2 months into watching this cycle, about a month and a half since June, every week chugs along. Every week, getting closer and closer to seeing this is exactly what is going to happen now. So if you're thinking of buying, I'm not being alarmist, nor am I being opportunist as a realtor and say, buy now. I'm just reading the numbers, reading the facts to you, and you'll be well served. Go and find the house you like today, make the offer today, and get in there now. All right, so touching on where are they buying? Another thing that's big in the news is that idea that condo townhomes are not popular. I think I touched on this. Already did this one. Sorry about that. I must have put it in there twice. Kind of threw me for a loop there. So let's get into the county data. All right. Now, before I go into it, my role at my brokerage is changing a little bit. I'm probably more and more data to more and more markets, but we're ramping that up. I have the ability to pull all the San Mateo data. I have the ability to pull any county. I have the ability to put neighborhood data in this format. If you need that, I'm not promising you because I just can't go and do 40 hours a week of pulling graphs and charts and data. If you're a consumer, our team can do it for you. If you want to know what do you need to know about your market, your home, your neighborhood, all day long, we can do it for you. We've got the team members to do it. We've got the expertise to explain it to you. If you're a professional and you don't have access to, or you don't know quite how to read this and you need my help, reach out, give me a call, send me an email, and we can find ways to partner and I can help you get what you need. Here's what I know doing this for the last 10 years, training realtors. When I put out information like this, there's like 10 to 15% of you that get it immediately. You can go out, don't need any help, don't need any explanation. You can go out and say, I know what I need to do. You can go on prospect, explain, and close deals, and it's fantastic. There's 15% of you that don't care, don't understand, have no interest. That's okay. That 60% of the middle is everywhere in between. Some get it, some don't. Some have access, some don't. That's really the group that I think could benefit from reaching out. Give me a call. Let's have a chat, and I'll show you how we can partner to get this information. And I can't stress enough, don't be that agent in May, June of next year saying, I wish I knew, or I knew, but I didn't know what to do with it. It's an incredible time for you as a realtor. Despite all the problems, despite all the limitations, the market is ripe for you. If you have any problem, any issue interpreting, dealing with this kind of information, giving your clients the information they need, give me a call, okay? So with that, let's go in here. Santa Clara County. I pulled out, this is only SFR. Usually I share all residential data. Because of the differences I showed you, what's going on with condos and townhomes, there's quite a disparity in the two. So it's skewing the data when you pull it all together. So I'm only going to share with you the next few slides, SFRs. Almost every trend I'm going to talk about here applies in every other county. Price points change, days on market change a little bit, but the overall trend is pretty much the same. And that's been really interesting. So here we go. Santa Clara County data SFR. You see from June to July, for sale dropped 6.1%. We had low inventory. We got a nice little boost after the stay in place was lifted. And now we're back trending towards lower inventory. Sold's up, pended's up. That's all really good news.
Somebody would like to know what MTD stands for.
Month to date. MTD is month to date. And I'm going to explain that next. So you see, looking backwards, July was not as strong in the for sale as it was in the sold and pended. We kind of knew that. When we share with you the forward-looking data, it'll tell you what's going to happen in the next month. I'm going to show you what that means for August, right? If you're waiting to understand August data in September, October, you're late to the party. You've got to know it now. And this is what that month to date means. So understanding the current trend, understanding what's going on, for example, month to date, the current month to date versus the previous month to date, that's measuring the first 11 days in July to the first 11 days in August. So where we had the trend from June to July of listings dropping by 6.1%, in the first 10 days, we have that accelerating. Not by a lot, but that's still, that can tell you inventory is going to get tighter, right? So this is where I start to validate what I'm telling you. The markets are going to get hotter. Prices are going to go up. If you're a buyer, buy now, not later, unless you don't find the right one, right? And that's just another hidden problem or really open problem with low inventory environment. $1 billion, $2 billion, it's got to be the right one, or at least very close to it. And I understand that, but you're going to have to live in it. So you're going to have to like it. But if you're waiting to fall in love, you might be a bachelor for a while. Sorry to mix my metaphors there. I don't know where my mind went for a second. So that's what that month to date is there for. I want you to see what's going to happen next. I want you with good data looking backwards. Oh yeah, of course, that's what happened from June to July. Well, you lived it. You should know it. What's going to happen next? That's where the power in this business, and that's when the power of understanding and reading data is. What's going to happen next? No one's going to call you and say, can you help me buy a house in June? They're going to call you and say, I'd like to buy a house in August. What's the market like? Well, here it is. So solds jumped, pendeds jumped. So far, first 11 days, dropped. Again, this is, we talked about it earlier in the year, did the spring market get delayed? And we said, yes, it went from May, June to June, July. And that means maybe, I know my kid started school. It didn't feel like it because she hasn't left the house, but she started school. A lot of your children started school. And this is usually when the market slows down. And so again, early days, even 10 days in, I'm not ready to call it for August, but this is the latest trend. For sell down in the county, sold down in the county, pended down in the county, compared to a really good month of July. All right. Average days on market, sales price, original list price. Again, you see what happened from June to July. Days on market grew, not a lot, but some. Price, listed sales price rose. You had to pay more if you wanted to buy a house in June to July. Flat so far, which is good. Combined days on market trending up a little bit, but we're still under a month, right? So it's fantastic market any way you slice it, any way you look at it. So this is what's going on there. The sold pending listings, this is really what I wanted to look for. Really what I wanted to see is, again, our price is going to continue to go up. That's reliant on demand. That's reliant on interest rates. That's reliant on the economy. And that's reliant on inventory. All right. What's demand like? I showed you earlier. Purchase block are up. What's the economy like? For the home buying public in Silicon Valley is red hot. Stock market is fantastic. Tech stocks, tech industry, all really, really good. Are there industries hurting? Yes. Are there service sectors hurting? Yes. Forgive me for a second. Those are not home buyers in the Silicon Valley market right now. So it's very important to understand that. I know there are issues. I know there are problems. But when we're simply talking about who is in the market to buy a home in Silicon Valley, that industry, those industries, that job market, that economy is fantastic. They can afford these prices, especially because we gave them a lower interest rate. So their affordability is lower. Last thing is inventory. Here we see from June to July, we've had that continuing rebound of new listings, jumped by 7.5% month over month. And then lo and behold, again, first 11 months, first 11 days, comparing a rising July, August is falling 12.9%. I mean, that's not bad news. That's kind of normal for an August this time of year. But you see, this is end of spring. Now we're fully into a summer market. We're later than we usually start our summer market, but it's here. Again, another week, 2 weeks, we'll confirm it, but this is pretty strong information a third of the way through August, all right? So fewer listings. If you don't have any listings, you can't have any pendings. If you don't have more pendings, you can't have more solds. And that just drives it lower and lower and lower. Those that remain in the market will pay a premium because there's such a scarcity of supply. Absorption rate pending sales. This is that forward-looking data that I love to share with you, and it has served us really, really well. I tell often the hardest part about managing or training realtors is standing up and saying, here's what I think is going to happen. Because when you're right, nobody cares. When you're wrong, everybody reminds you, right? So you can't be wrong in this. You stand up and tell me what's going to happen next. But this is why absorption rate and measuring it and watching it has been so helpful for me. Is stand up and tell you, I know what's going to happen next because this is a great indicator. And so you see the absorption rate, which simply is kind of the inverse of days on market, where days on market is how many days would it take to buy all the inventory on the market, which is more strongly correlated to number of inventory you're starting with. This is how fast does buyers soak up the available listings? At what rate do they soak them up, right? Obviously, the higher the number, the better. So those who get with us for a while, even when we were down here, we were like, it's going to get hotter and hotter and hotter, and we were right. Look at June to July, from 100% to 115%, massive jump. And in those, when we were in June, when we were reading the mid-June numbers, we could tell you this is where it's going because we watched the month to date. So coming off that 115.5 high, which I think is the highest we've seen in like 3 or 4 years, the first 11 days, flat. Not terrible news. 98% is a fantastic number for sellers and homeowners in a market. That tells you it is firmly, deeply entrenched in a seller's market. It is over 60 points away from a neutral market, almost 70 points away from a buyer's market. So again, hate to be the bearer of bad news if you're a consumer listening to me today and you want to buy a house and you're thinking, aha, absorption rate drop, I'm going to go in there and just get a deal. No, you're just not going to have to go as high as a percentage as you did a month ago. You're still going to have to go higher than asking in most cases. That's what that's telling you. Again, if you're a seller, I'd rather sell on the uptrend than a flat or a downtrend. And again, that's why I say this is a great time to put it on the market. It's still great. And then the closed sales, again, trails the absorption rate. It's a trailing indicator. Very good year, very good month, June to July. Again, we see trending downward for August. But a 79% would be in this range. It would be one of the highest numbers in the last 8 or 9 months or so. And watch for this to continue. It's going to continue to get hot. All the conditions that you need for a robust seller's market are there. Low and dropping inventory. High and growing or sustained demand. Incredibly low interest rates. Affordability. It's hard to ignore price. But when you're in the market, it's really about affordability. Sometimes I can afford to supersize my McDonald's meal. Sometimes I can't. It's not because I can't afford a supersize. It's about affordability, and you have to do a little bit less. Again, a weird analogy, maybe, but that's what we're talking about now. It's the affordability. If you can afford 1.8, go for it. It's a good deal. If you can't afford 1.8, you got to buy below that. It's a simple concept. But when you break it down to these numbers, these metrics, look backwards, see where we've been, look forward, see where we're going, you'll understand why I strongly feel, and I'm really back in future weeks, and you'll be able to tell me in real time he was right or he was wrong. So there's nowhere to hide from me. But the data is the data, and everything is pointing to rising prices, a really competitive seller's market. If you're a buyer, go in now, get in these lower prices, make the equity gains yours, not the current owners. And if you've got any questions, I know this is hard. There's a lot of stuff there. I've been doing this every day for 10, 15 years. Sometimes I feel like I do it in my sleep. I don't know if that's good or bad. But if you're out there thinking of buying or selling, give us a call, give my team a call. We're well equipped to help you in any way you need. If you're a professional out there and you're struggling, you should not be struggling right now. It's a great market as long as you know what to say, how to say it, what context to put into it. The buyers and sellers really need your expertise. They really need to talk to agents. They need to talk to mortgage professionals that understand this. They're going to pay a lot. They're going to pay higher and higher prices. They're going to put more and more of their paycheck into their property. Shouldn't we give them the best advice possible? It's not about the commission. It's not about any of that. It's they need your help. Be ready, be informed, be knowledgeable, and be strong in your response to go out and give everyone the information they need. If you need help, give me a call. Trained hundreds of agents over the years. I can help you too. My team can help you. We're a full service team. We train, we teach, we sell, we list. We can do it all. So hope you enjoyed it. If you've got any questions that are lingering, send us an email, give us a call. I would love to help you, love to talk to you. It doesn't matter what industry you're in. If you're a title rep, I can help you. If you're a lender, we can help you. And I'll finish with that. And if there are any questions, anything that you need, if you want the slides, want any support from us, Robert Cruz at Intero Real Estate, Intero.com. I forgot we shortened it right here. That's the best way to get a hold of me. I'll send you these heat maps that show you what's going on in active listings in the county. I have these for the Peninsula and South County also. You can see the disparity, inventory dropping just about everywhere except Sunnyvale and Santa Clara this week. Pendings rising almost everywhere. And the absorption rates. This is what I was really talking about. Everywhere you can see this year, buyer demand in each local market, much higher than it was for the same period last year. So just to pull out a couple, Alum Rock. Strong summer last summer, 91% absorption rate in Alum Rock last year, almost double this year, right? For God's sake, go help a seller there and make a buyer happy. Everywhere you see that number this year, much higher than last year. And that is translated into the closed sales. The only one that is lagging, Berryessa. It was almost flat, but everywhere else, super strong year over year. All right, my voice is giving out and it's 7:01, so I am done. Thank you for joining us this evening. Robert Cruz at Intero.com. If you want to give me a call, 881-4810. Would love to help you, whether you're a buyer or seller or a professional that needs some help. We can help all of you. All right. Have a great evening. I'm pretty confident we'll be ready for you next week again with some more information. With that, have a great week, and we will see you soon.